All right. Good morning, everybody. Caught a few headlines yesterday on the size of the push off of those lows. Looks like a record inflow. Pretty interesting. That's a lot of push. $1.35 trillion added to the U.S. stock market yesterday, making it the largest single day gain in market history. That's pretty big. That still doesn't mean we're done. It's a push off the lows. We're still expecting to run into resistance, and we still need to get through the tariffs. So all of this is this push is being attributed to her has adjusted so many times that all it would take to see us find resistance would be another tweet or another comment about how egregious these tariffs are going to be, and down we go again. So something to keep in mind. April 2nd is supposed to be the deadline. More than one person has suggested it's likely that we'll hear something in advance of that it won't get all the way there first. So, I wouldn't wait until the last minute to make an adjustment if you are waiting on those tariffs. Small caps are in the red. NASDAQ is flat, S&P flat, same with the Dow. Japan up 0.5%. Europe doing better than that, close to 0.75. And for Euro Stocks 50, it's over 1.25. So, if we're having that discussion about money always being in the market, but just moving from location to location, Europe up, US down, Japan, Hong Kong, Europe up, US down. Sounds like money moving in the other direction to me, moving in the same direction that took us to the downside in the first place. We're going to get some housing data this morning and consumer confidence numbers. This housing price index, the consensus number is 2, but I heard some talk of it going in the other direction from a 0.4 to a 0.6. That's going to be going in the completely opposite direction of the consensus. So watch the clock this morning, 9 a.m. If we get an outlier number going in the other direction of consensus, that can add to the bullish push, because this 2 is a slowdown from 4. It's not, heavily negative on the slowdown, but it is a slowing. So if we go to the 6 instead of a 4, we not only didn't slow, we increased. And that, of course, would add to the bullish bias and fuel the drive to the upside. We've got Fed speakers today with Williams just after 9 o'clock. The consumer number, now, sentiment is what got us in this mess. So it's worth keeping our eye on confidence and sentiment. We have auctions later in the day at 1 o'clock. So once we get past the auction at 1, unless we have any other Fed speakers this afternoon, we should be good to go. And looking here, we don't have anybody else chipping teeth. We've got European Central Bank at 11, then the auctions, and we should be good. I think there's a repo today that we should hear about as well, but that's it. So once we're done with the auction, we're done. markets still aren't feeling threatened. Puts are still cheap. So we've been talking about this potential bear flag for a while. The idea that we had the flagpole, and then we started building the flag out, and the 786 was our line in the sand. If it was going to be a regular flag, it would just continue to the downside. If we were looking for it to not be a regular flag and to actually fail, then we would look for a move to the upside. And that's what we started to get here. 5,900 is the goal. It's the first target we want to get to. We need to get above that and then prove that we can keep it. Just getting to it is going to be difficult enough. Getting above it, holding above it, that'll be the resistance that we need to get through. Otherwise, this is just a kind of a bigger dead cat bounce, or just, you know, a market that finally found support and is running up into resistance before it legs over and retests these previous lows. We are really close to the 0 gamma line. 58.32 cog line, or 58.29. We got some voodoo lines above that, and then the 10-week moving average. We're above the volatility trigger, so markets are likely to not move as much on a day-to-day basis, right? That's one of the defining characteristics of that volatility trigger, is how markets behave. It's not to say that we can't get a feedback loop, because we're really close to that volatility trigger, but generally speaking, those feedback loops happen underneath the volatility trigger, and we're not underneath it anymore. We are resting on the 20-period moving average. That's 58.04. It's this green line. We cut above it yesterday, so we want to keep it. We had this gap that we hit yesterday. It was when price closed here and opened here, and that left a gap target. So we ran up and hit it yesterday, rejected off of that actually in the later part of the day and fell back down. And then we got back up here earlier this morning, again rejected, came back down, and now we're back there again. This is unfinished business. We don't know how much liquidity is there, but we are working on it, right? That's what we're doing right now, is trying to work through it. So maybe we get it all taken off the board and we're able to move through that spot in the pre-market. Otherwise, you know, it's likely we test it again in regular trading hours. If they continue to press that level and can't get through there, we have to consider at what point are they going to give up. Because if they keep putting in the effort and they don't get the results that they want, they'll try something else, like a wash. This is the kind of behavior, though, that we do see when we grind through a level. These really swift spikes up into a level like that very often get rejected. There's just not enough underneath it to hold it up. Causes a liquidity gap and we dump back down again. Same thing here. When we got up there really fast, there was nothing underneath it, so we just fell back down again. But when we grind our way up there, it's more likely we have the sustainability to just continue to drive right through that. Since we're basically flat on the morning, we don't have any edge on which one of these red lines we're going to hit today. It's easier to hit the lower red line since that is inside yesterday's trading range. We would have to get out to hit the upper edge. So just from that alone, there's less resistance to hit the bottom one. But the market is green, even if it's mildly green. We have a really narrow initial balance. We haven't done much all night. We didn't even get much of a move through the kill zone. And at this point, we're looking for something that's going to kick this market into gear and actually get us to go somewhere. I would be focused on yesterday's 111 at this point. It's one of my favorite trades. We're already primed for a breakout of yesterday's high, and we don't have any of the sectors and any of the hyperscaler names that would generate a rally that would continue yesterday's drive at this point. So that can come in after the open. We can start getting options flows, the breadth coming in, sure, all of that, but we don't have it right now. So a breakout into 111 or 1236 and then rejecting that, coming back in the range. That's the base case argument at the moment. Yesterday was an MDP. It doesn't count for yesterday, it counts for today. So far today, we also have an MDP. That's a missed daily pivot. We have a pivot here and we haven't hit it. It's as simple as that. Today's won't count until tomorrow. We often get them consecutively. Price is supposed to hit that pivot. It's what it does 80% of the time. So it's bullish in an extraordinary way that we didn't first hit that pivot. The channel today is as wide as the channel yesterday. A wide channel implies that even if we do break out, the breakout doesn't stick. Obviously, with yesterday's price action and that wide channel, we broke out, we ran, it stuck. These channels don't make price do anything. They just give us some insight on what we're supposed to expect out of price. So we have, again, another wide channel today, implying that if we break out, it won't stick and we come back in again. Just because it was wrong yesterday doesn't mean it's going to be wrong again today. Nothing is infallible. And it's just a gauge on what our expectations should be. Doesn't make price do anything. Today's floor pivot is a cog line, 5792 cog line. So 80% chance we hit 5792 because that's what price does, is hit its cog line, hit the floor pivot. And if we hit it and we get underneath it, we'll test the RTH low of yesterday. If we get through that, then we'll test Sunday's open. And beyond that, we'll test Friday's close, level by level all the way down. We didn't make it to an R3 yesterday. We got above the R2, got a Busby off of that, and then continued to run all the way up to the gap target. But we weren't able to get to R3. This morning, the ranges are wider. Not massively wider, but we got a wider range. And we're still not at R1 yet. When it comes to the S&R levels, there's a strategy where we pop into R1, and then that is a short trigger to S2. It would look something like the idea that chopping about, get the drive up into R1, and then you short into S2. That would line up with hitting the ADR on the lower side. 5811 cog line is the same as this point of control from a couple of weeks back. It was the first week of March. We got a really clear distribution here, almost a classic one. So once we get above that, it starts to diminish. The volume profile got more and more narrow. And it really doesn't start to pick up again until we get into 59.50. So above 58.50 is a 100-point move. And if you remember those pictures I shared a couple weeks back where we dropped down into 59.50, digested for a couple days, had lower wicks, broke down to 58.50, digested for a couple days, setting lower wicks, and then dropped down to 57.50, did the same thing, and we dropped from 57.50 to 55.50. We didn't stop at 56 on that way down. It was a jump. So now we're working our way back up. 58.50 is the structure we've got to get through. From there, it's another 100 points to 59.50. We'll have another structure that we have to get through. It's just same thing in the other direction, right? Working our way through. All right, we're going to be working through this volume where the point of control is down below. This is 10-day, 30-minute volume profile with TPO. And we left the point of control behind, driving out through it. This range that we've been in forever has finally been broke. You can see we've expanded beyond that, and we're already putting in a significant level of volume at this new stage. So each day that goes by, we're going to get a new candle on the right. We're going to lose a candle off the left. That's going to diminish the volume on this volume profile from the point of control, and it will eventually move it up to our current location, 5811 cog line. The goal is to not be there when it gets there. We want to bring that support up, but we don't want to get stuck with it, right? Like we were down here. We're not seeing the same amount reflected on TPO as we have in the volume profile either. No new VPOC today. We've already hit that level, cut through it multiple times. It is worth looking at our own profile this morning. This is, it's not quite a lowercase b profile, but that's what it was working on. Generally, I tend to put more attention on yesterday's profile than I do today's profile. But if you are watching today's, as we get up and break this high, we want to see the volume and the TPO both start to develop a high profile here, like we hit a liquidity zone. See if they're defending that high. They didn't front run it, unless we want to consider this area here where they front run it, and they didn't match it in TPO. That lines up with the rejection that we saw. And we are on the edge of the weekly expected move. This is how far we were supposed to run for the entire week. We did it in a single day. Now we're looking for a breakout on the week. So one of the things that we can do when we get this sort of situation is we can measure the range on how far we were supposed to go for the week. And we can plot that to the upside as another level of how far we could go. Technically, this is a 1 standard deviation range that we had, and doing what I just did does not make it a 2 standard deviation. A standard deviation is 68 point blah, blah, blah. And a 2 standard deviation is like 91 something, 92. So doubling a 68 does not give you a 92, right? That's not how it works. But just off the cuff, nice and generic, take the range that you had, project that to the upside. Now, I have seen people use the fib levels, especially my 111 and my 1236, and measure this range and project those with an extension. I don't really have an opinion on that at this point. The levels that I use, I adapted them and built the system that I use. It's mine. I can do whatever I want with it, and I know it's adaptable. So I thought it was interesting when somebody showed me that. If you want to consider it for yourself, by all means, take a stab at it. I just don't have an opinion one way or the other. We're still below the 10-week, but we are working our way back towards it. The 10-week is often considered the mean. So if we were going back towards a reset point, the mean would be that reset point. Getting back there, hitting it, maybe overshooting it a little bit. So if this is just a bounce into resistance, that would be my target. And that should line us up really close to that 5,900 level. 5,900, 5,911, something like that. On the 10-day, we're above it by 1%, so we're out of its gravity range already. We're not at the point where we would say we're overbought or overextended, because we're only 1 and maybe 1.25% away. But if we get another 1% move or another 1.5% move, that would get us above 2, and that would start putting us in an overbought territory where we would have to start considering the idea that we're going to reject and fall back the other direction because we moved it too fast. At this point, we have not moved too far, too fast. It does not owe us a pullback or any sort of whiplash or mean reversion back to the downside simply because of how fast or far we went to the upside. Not yet. I didn't say it, but now that I think about it, I think we better. This lower pivot down here is 5711 cog line. It's the weekly floor pivot. I've tried for years to define how far from a pivot point can we get before it's too far and we fall back the other direction, or we go back the other way. I've tried the same formula that I use with the 10-period moving average. It doesn't work. I've measured these by hand, and the downside distance is at least 50% greater on average than the upside distance. But how far we are from this weekly pivot, we get to a point where it's, quote, too far. And no matter how many more times it tries to drive higher, it won't drive higher. It'll get fake outs and reversals, and it'll come right back in again. This isn't even 2%. And I've measured it before where I've seen 2.5, closer to 3%. But that's extremes. That's like one of those QRA FOMC combos where we get like 3 days of bullish drive to the upside, and we get this really extreme move. We've only had 1 day, but that 1 day already took us a long ways from that floor pivot. So if we get another 0.5% or another 1% drive to the upside, we may have reached just about as far as we could reach in a single week. And anything more than that is going to reject us and dump us back down again. This says 1.9% from the weekly pivot point. I would say 2.5 to 3, 3 being the max. We get that far away from this weekly pivot, and that'll be as far as we can get for the week, unless we get some just wild, crazy news that pushes us beyond that limit. Now, once we reach that limit, it doesn't mean that we're going to fall and come back in again. It can hold the highs at, say, 3% from the weekly pivot and just stay there for the rest of the week, chopping about in a 20 to 50 point range. But it would certainly cap our drive to the upside for the week, because there's only so much you can get out of price, typically. China's down, whether we're using YINN or KWeb. China's down either way. Emerging markets is basically flat, and that's also China. So if we're looking at all of the different China tools, that's the only one that really isn't down all that much. MCHI is almost down enough, the benchmark being 0.5%. So we got Bitcoin and China both down. And this FNGD, FNG is the fangs, and this is down volume. Down volume is down. I know how confusing that sounds. When we flip this over and we look at what's up, we would want to see FNGU, which is the fangs up volume. We'd want to see that the up volume is up. Down volume being down just means that the Mag 7's negative push isn't very negative at this point. What we do have to the upside this morning is gold miners. There's the Mag 7, or if we want to use our homemade little ETF, is the Mag 7 again. We want to see the Mag 7 up volume, FNGU right there. Not up by very much. So the down volume is really down. That's good to see, but we don't have any up volume right now. So that's not helpful, but at least it's not negative. Take whatever little treasures we can get, right? So China, Bitcoin, bonds, agriculture, and China again. Uranium's almost down enough. Not yet, but almost. Silver, gold, pot stocks, solar. We don't want a rally based on pot stocks and solar. That is unsustainable. It won't work. So we need to do better. We need to have better sectors to the upside. And if we don't get those, and we're still looking for a bullish breakout today, then we have to look for news or options flow to come in. And we can't see that in the pre-market. We can't predict news that isn't on the schedule. But that's all it would take. We don't have the names that we need to see. And if we're looking at, pre-market breadth, how many names are up at least a 0.5% in the NASDAQ? 9. That's not very bullish, and these aren't the names we want, right? These aren't the droids we're looking for. Meta, okay, we got 1, and Tesla 2. That's it. And after Tesla's wild run yesterday, the fact that it's up again this morning, that's kind of impressive. It was almost a guarantee that it would have been pulling back at least a little bit, right? That was a phenomenal run. More than 13%, I believe. So it is impressive that it's up again this morning, and then Meta is up, but that's not enough. Those two alone just aren't going to do it. And then looking at the S&P, names that are up at least 0.5%, 6. Well, that ain't going to do it. If we're going to have a bullish day, we need more than this. And while we got some banks in here, It's one of the 3 sectors that we would want to see for a bullish day. That's not enough. Taking it in the other direction, NASDAQ down 0.5%, only 3. And for the S&P, only 3. So we don't have a negative bias. We don't have a negative sentiment. We just don't have a positive sentiment. So we can spark a rally day, but at this point, it won't be the Mag 7. It'll have to be surprising news, either through the economic calendar that we already have, some tweet or random surprise that we didn't see coming, or options flows. If the swag level on the VIX is 19 or 20, we're already below that level. The next one is a lot farther down. It's like 15. So we're not going to get any real help out of the VIX at this point. Yesterday's drop really helped out in that rally that we had. But that was just sealing the deal under 19 and really just locking it in for us. The VC funds now aren't going to really react again until we get below a more significant level. But on the other hand, keep an eye on this, because if we start to drift back up, that 19 level is going to be in play again. We get above 19. I like 20, but I know there's some really smart analysts that use 19. We get above that level, we could start to see VC funds step in again. So it's worth keeping an eye on. But otherwise, 15 is too far away to really help us out. I can't see the VIX getting down to 15 and then falling below that today. We would have an S&P that'd be taking off like a rocket ship, and that's not expected. So that's not really going to help. A continued move to the downside in bonds would help. But it's only going to get us so far. We got to break this 89.5 and really commit to a downside move. So close below it, get a really clean move below that level. We can see that we're through it, but we got to keep it. So watch this one into the open. As long as it's holding underneath that 89.5 and it doesn't start making a run back up towards 89.5, then we have the potential to get that breakout that we're looking for. We're in an environment where yields up, equities up. So we don't want to see bonds start to go up. Pretty easy day, guys. This is what I got for you. Keep your eye on the clock. Once we're done with the 2-year auction, should be good to go in the afternoon. Be careful, be safe. I'll see y'all tomorrow.